Hello, everybody. Welcome to the Real Estate Investment Club. Today, our speaker is Bob Bowman. Bob Bowman has been involved in commercial real estate office space investments for quite a number of years, and I'll let him give his own introduction. One thing that Intel HR does require me to say is that the views and opinions expressed by this club and any of the speakers in this club or any of the people attending this club are not the views of Intel. And so guest speakers and audience members' views are their own. If you want to ask Bob questions, feel free to put them in the comments section. So we can, I will read them. I'll do a little bit of filtering on them just to make sure they're on topic. And we will probably answer a few of them as we go through, but we'll hold the majority of them till the end. So without further ado, Bob, I'll turn it over to you.
Okay. All right. Well, thank you. Let me pull up my slide here. Okay.
Am I still sharing, aren't I?
Yeah, I don't think we're sharing yet.
Okay. I stopped sharing, and you're free to share now.
Okay. All righty. Let me go here. Okay. All right. Let me pull up my slide presentation. Can you see my slide?
Not yet, but it looks like it's loading.
Okay.
Okay, we can see it.
Okay, and do you see the one slide, or do you see all the slides on the side as well?
We see all the slides on the side as well.
Okay, so let me just go to the slideshow. From the beginning. Here we go. Okay. Well, this is my first time with Skype, so I apologize for not being real familiar here, but with this. But thank you, Daniel, and everyone from Intel. For me, it's a real privilege to spend a few minutes with you today to talk to you about one of my favorite topics is commercial real estate. And so what I thought I would do is just give you a little bit of background about commercial real estate and share with you whether you're interested in commercial real estate as a investor. Maybe you might have some IRA money or some money and you would like to invest it with somebody, or maybe you would like to buy property for yourself or perhaps partner. I'd like to share with you some of the biggest mistakes that I have seen brought to me that might help you when I'm looking at initial investment opportunity. And then the second part is I'd like to share with you, we're in a very unique place right now with the pandemic going on, and with everything that's happened there. I'd like to talk to you a little bit about COVID-19 and commercial real estate and how we're dealing with that as an owner operator myself. So I'm an owner of operators, my wife and I, and we own over 1,000 apartment units. And my smallest one, I'm just going to give you a real quick background here, was 34 units, and my largest single apartment was 384 units, and that was quite an undertaking. But both assets and all of these were all of the properties were both asset and tenant repositionings, and then along the way. When the apartments got really expensive to purchase, and I work off of a very, very specific business model based on cash flow, I ended up acquiring over 200,000 square feet of office space about 5 years ago. One is a property in Dallas, Texas, and the other one's in Charlotte, North Carolina. So I'm going to show you what those are, what they look like. I'm also an educator. I do a class about twice a year for another investor and teaching people how to raise private money for their deals. And I also teach commercial real estate, how to identify, how to underwrite, which is very important, and then how to go through the various leases, etc. And so I teach a class 2 times a year. And then while I was doing all of that, I had a lot of difficulty finding a great underwriting tool, so I hired a programmer and I created my own software. It's called Commercial Underwriter software, and it underwrites all types of commercial real estate properties, and that's what I use. and we are. I'm getting ready to launch that product nationally here in the next several weeks. So, just a little bit about my background. So, one of the first properties in commercial real estate that I have, it's called Rockwell Commons. This is about a 26,000 square foot rentable square foot building. It's actually outside of Dallas in a town called Rockwell, Texas. And throughout the entire coronavirus and where we're at today, it's always been 100% occupied. I had a problem with one tenant because of the virus, but we worked through it with them, and everybody's paying their rent. And one of the reasons that I've done well with that is because of the type of tenant mix that I have in this building, and also in the market that I'm in. The market occupancy is 98%. So that's a really important characteristic when you're looking at either being in an investment or having your own investment. The other one that is significantly larger is located actually in Charlotte, North Carolina. It's called Highlands Business Park. And Highlands Business Park is about 180,000 square feet. I have 51 tenants, and there are 7 buildings that look like this. And I really, really like this building type. As a matter of fact, one of the interesting things about this building type, and we can talk some more, is that it never went below 92% occupancy during the entire real estate crisis back in 2007, 8, and 9, et cetera. So I'll expound on that a little bit for you. But while the entire market in office was in the 60 percentile, high 60s, this particular building type and its location never went below 92%. So, there's some really exciting opportunities in commercial real estate, and I am planning actually to buy more. Now, let me just share with you, first of all, on a little bit higher level, the different types of commercial properties, because there's really two. When we think, out in the world of financing, residential properties are, typically a single family home or up to, 5 units, and then, from 5 on. Then you go from getting a residential loan and you move into commercial loan, and you start underwriting them or analyzing them a little bit differently. So in the commercial realm of evaluating commercial opportunity, we have what's called a unit-based underwriting and analyzing. So a unit would be, of course, storage units. Mobile home parks, if you like that commercial type property, which is very, very strong cash flow type property, they are evaluated by pads. How many pads, whether there's a mobile home on that pad or not, you still value that and underwrite that by the number of pads or units, if you will. Apartment units, and of course in student housing, you evaluate that by each bed. Each bed is a unit. So we have these unit-based type commercial real estate properties, but the rest of the world and the huge opportunity out there is for square footage-based type properties, and that would be offices of all kinds, retail, shopping centers, and strip malls. If you like warehousing and industrial, which is really hot right now, by the way, and it's even becoming more important to find these properties, because with more and more companies going online now and taking a direction and actually making some paradigm switches here, they need a place to warehouse their product. And then, of course, another very, very strong commercial property in all different types of markets, whether the market is up or down, is we refer to medical office buildings as MOBs, and these are the offices that where there's multiple doctors and sometimes practices in them. Healthcare is very, very stable, as we know, and so there's always that particular segment of the commercial property types do very, very well all the time. It's very stable. So basically, those are the two types. So one of the reasons, and I think this is probably one of the most important things I want to share with you that I like about commercial real estate and the square footage based type properties as opposed to an apartment complexes is that if I could just sum it up in a nutshell, there's more work to do up front when you buy any kind of commercial property, an office building, if you will, or retail. But after you close, the work on the back end is far, far less than it is operating an apartment. So, in our office buildings, our leases are 3 to 5 years with options on them. We're an apartment every year. I have to renew that tenant, and now I also have to be concerned if they're going to move out. So in my commercial properties, I have significantly better stability, better financial stability. Secondly, the tenant is more willing to improve their space and add value to their building. I have one tenant, and it's a national tenant that is renting, about 5,000 square feet of my 180,000. They just put $85,000 of their own money in that space, and I put up some money too, so that they can improve the property. But can you imagine an apartment tenant saying, "Hey, don't worry about that, Bob. We'll go ahead and put the carpet in, and we're going to put some new fixtures in." That never happens. But the business owner that is in your building or in your space in one of your buildings, they really do care, because that business tenant will take better care of their space because they're bringing their clients there. They make their livelihood in your building. So it's really important. And once they establish a building, they don't want to move. They want to stay there unless they outgrow the space and you have no more space for them. Or the only other reason they might leave is that if they have a problem with their business and their business downsizes. But even if they downsize, if they're still in business, they can still stay there, and they want to keep their clients there and occupy their space. And so these tenants are more likely, and they pay their rents on time. Most all of them pay their rents from the 1st through the 5th. In an apartment, the apartments that I own, these tenants pay whenever they can. And if they go past the 5th or the 10th or the 15th of the month, we have tenants that pay all the late fees, but they pay every month, but it's always late. Sometimes it's partial. And so, I really like the consistency of revenue. I like the quality of the tenant. And and these tenants that are bringing their business to you, and want to rent from you, they want to make sure you as an owner, are you keeping the property landscape? Does it look good? Is there ample amount of parking for their customers and their employees? What does the parking lot look like in the buildings? Are you keeping things neat and clean? And so, so it's really important. So as a business owner, all I have to do is make sure that I do a good job servicing them and, keeping up on the things that I need to do. And then, the tenants add value on their own. So it's a really different relationship between you as the owner or manager of that retail space or that office building, and then somebody that owns and manages an apartment and that tenant. I really, really like it a lot better. So, here's a few things. Some of the biggest things when we're looking at properties and people's underwriting and their pro forma, they have an investment. I got this office, this commercial building, so what are you planning to do with the property? And, how are you going to execute this plan? Those seem to be a couple of things that when I first start talking to somebody about their great investment, that they would like us to, provide them with some kind of, some funds or, participate in some way. I kind of really want to know what's going on. So here's some of the things that I've really seen, and I see it often, and I'm just going to run them off for you, is that they overstate the income, by over projecting, what the property is going to do. So they have unrealistic projections, and so that's no way to buy or invest in a property. So, they have, unrealistic execution. So what could that be? Well, maybe you have some space to fill. And so they say that, the person bringing you this investment says, well, we're going to fill all this space in the first 6 months. And then the questions would be, well, how long has the space been vacant? I had a property I was looking at in Clearwater, Florida. I live in Orlando area, by the way, Orlando, Florida. And it was a really nice building. It was 3 different buildings. It was in a great location over in Clearwater, Florida. It just, well maintained, on and on and on. So, and it was about 90% occupied, but there was a space there, and it was a pretty good sized space. And I said, well, how, why is this space vacant? They go, and how long has it been vacant? They said, well, it's been vacant for 7 years. I go, 7 years? How could that be? And they said, Bob, look around. There's no windows in here. So, people were reluctant to take that space. And so, when somebody says, we're going to fill up this space really fast, and what they do, they put their numbers and their revenue numbers, and they're expecting to do that. And so, a lot of times I feel that people they have unrealistic expectations on how quickly they're going to bring that space and bring a tenant into that space. Many times, there is not enough capital to execute the changes that they want to change. And it's like for any of you that have either owned or have a single family home that maybe you rent out or something, and when you bought that, you went in there and you were going to make all these great changes, and no matter how good you were, how much you analyzed that, and you knew what had to be done, there's always something that you find, and that oh my gosh, I didn't see that until you get into the project. But some of these projects that I see, they're pretty well underfunded, and there's a reason for that. And also the other thing is that when you're comparing about how you're going to take that investment and move it forward financially, the person bringing the investment to me, they haven't really done their due diligence on the properties and the rental comparisons. And those would be competing buildings that are built around the same age in a 1 to 2 mile, 3 mile area. And the biggest one, if you can believe this, they've never seen the property. They bring me a deal and they think the numbers are great, but they've never seen the property. So you don't know how much money you need in order to be able to bring the property up to par so that you can lease it out. So the most important thing, and this is what I do, I love numbers. I love to put deals together. Underwriting is the most important thing in analyzing that deal. So here's some basic principles in commercial real estate. And I also do this with my apartments. Number one is I follow the cash. So if we were, Daniel, if you and I were going to be in an investment today, and we were going to look at an office building or a strip centers that, if we close today, how much cash are we actually going to have to validate? Not what we're supposed to have, not what the broker says that, oh, if we do this, this is what it's going to be, because the value of any piece of real estate is only worth the cash that it produces today. It's only based on the revenue that it is doing today, not what the seller hoped it would do or what it's supposed to do, or if you put all this money in there, this is where you can move all the rents. No, it's only worth I call it stated in-place income. It's only worth the income it produces today. So use only seller stated income that's verifiable. And we'll go into that office building, and when we'll call the property manager and say, send me the last 3 months of bank deposits so we can see every tenant on those bank deposits that paid their rent, and we want to see the 3 months of bank statements so we can verify that that tenant's money went into that account, and we can verify that amount. The other thing is that when you're looking at value and you're determining, well, is this a good deal or a bad deal? One of the things that you get tripped up on a lot is the TILC cost, and TILC stands for Tenant Improvement and leasing costs. So tenant improvement, whenever you want to bring somebody new into your property, you're going to rent that space. A lot of them will say, well, Bob, I'll rent this space from you, but I want you to replace the carpet. I want you to put a wall in here, put an office there, and I'd also like to have it painted. Or you might, so you have tenant improvement costs. And even on your renewals, you might have to do something, but it costs more money at the beginning to bring that company in. And then in leasing costs, unless you're going to find and operate the space yourself, if you do not have a real estate license, then you're going to have to pay a company that is out there in the market and they specialize in your property type, and they'll find all the tenants that you want. And so you pay them a commission. Typically it's 3 or 4%. If they co-broker it with another broker, then it's usually 6% that you have to pay, and they'll split the commission on that. So when I look at a value of a deal, and I look at the TILC cost and the capital cost in the underwriting, I have to ask myself, is that below or above the line? Because there's a little trick there, that it's important to know. I'm going to show you in a moment in a financial on why that's important to the value or the lack of value if you're going to get into something like this that you need to know. The other thing is that what's different than unit-based analysis as opposed to the rest of the world in square footage-based analysis when you have tenants with these longer leases, there's a thing called absorption and turnover vacancy. And what that basically is that these are the tenants and the amount of square footage, and their leases are expiring. So how many of these, based on, the amount of leases expiring in any given year, are you going to turn that tenant over? They're going to leave, or you're going to absorb that a tenant and they're going to stay with you. So in commercial real estate, we have a general vacancy, which is, this is the general vacancy that we think that this property is going to be 5% vacant the entire time we own it. But, if you have somebody that has 50% of your square footage, that could be a huge liability. And so that turnover and absorption vacancy is going to be a lot higher than 5%. So, there's a lot to talk about with commercial real estate, and, sometime down the road, if we want to talk more about, as an investor, whether you're buying or you want to contribute in an investment, I can take you down that road and I can show you some of these things from the financial side that you want to be keen on and that you want to know and see. So let me just show you this right here. You notice that on the bottom here, it says leasing and capital costs. So you have two things. You have your effective gross income right here. And month one, this is our stated in-place income from the seller. This is an actual deal, by the way. This is the stated in-place income. So we have our income here, and then we have our expenses here, and then we have our net operating income. Now, what will happen is that a broker will take this net operating income, and this is important, they'll slap a cap rate on it. And then they'll say, okay, well, from the net operating income, that's what the property is worth. But when I look at an opportunity, what they don't figure, and this is our first year of operation, they didn't consider tenant improvement cost, leasing commissions, and capital reserve costs that the lender's going to take out of your mortgage payment every single month. So here I have $216,000, and if you're dealing with a broker that really doesn't understand how to value a commercial building, or if you haven't taken what your cost to operate in, it's you've got 1.447 here and 1.231 here. That's over a $25,000 delta or shortage. So how are you going to make your investor payments if you haven't calculated? You don't have enough cash to do it. And then from there, if you look down here, we have our debt service that we have to pay here of $703. So, so we really have like $500,000 left. But I find many people leaving out the real cost of operating a commercial property. And, I find this especially where you have a really good broker, a residential broker, and they have a friend that owns a strip center or office building or a little warehouse or something, and and they don't know anything about how to underwrite a building like this. So so their numbers and their values are so far off that I can't even talk to them. And when I start asking them about TILC, and then there's another thing called renewal probability, they're kind of lost. So if you look up here, I'll show you this last thing here. See, there's my base rental revenue, okay, up here, okay, that's at 100% occupancy, but here's my absorption and turnover vacancy. Okay, these are leases that are expiring, and so I take a percentage of that, of the square footage that's expiring, and there's a calculation to do this. I do this in my software, my commercial underwriter software. And then I have rent abatements that's basically concessions in apartments, but these are discounts or inducements in order to get somebody to move in. And then we have some other costs. And then right here's our general vacancy. Now, whenever I have a general vacancy, and I have an absorption and turnover vacancy that's greater than the general vacancy, the additional losses will show up, and my additional costs will show up in my underwriting. So it's really important that, when you're looking at an apartment or unit based, you have income minus expense is your NOI. You pay your debt, which is your mortgage, and then you have your number. But, in commercial, in this part of the commercial, you have to consider the TILC cost and then your cost per square foot for your capital reserve that the bank's going to take out. So this is what when you're looking at a financial, if somebody brings an investment to you and they say, hey, would you put $50,000 of your IRA, into my deal, you don't see this down here, then your deal is going to come up short, significant amounts of cash depending upon the tenant profile that's in there and how much square footage they have, and if they're going to stay in that space or not. Okay, so really, really important. Now let's talk about for a few minutes the COVID-19. I want to share with you what we've done. And so basically right now, everywhere in the United States, everywhere, it seems like if you have an investment property, a commercial property, or even an apartment, any kind of commercial real estate, and the market that you're in has a lot of technology companies, or you have a lot of government entities there, maybe you're in a capital somewhere, a capital city, then right now, those particular properties in those markets in general are doing better than all other parts of the country. Now, I happen to own a 100-unit apartment in Huntsville, Alabama, and I am 100% pre-leased. Everybody's paying because I have in Huntsville, Alabama, for those that might be familiar with it, they have incredible technology. Boeing's there. They have NASA there, and there's tremendous technology and government right there in Huntsville, Alabama. So, I kind of got lucky right there during this particular time. So, the question is, so Bob, what are you doing? And for people that can't pay, or what's going on here in the market? What this is here is about 3 weeks ago, CoStar, they started doing analytics about 20 years ago. And so based on looking at what happened back in the Great Recession, and then kind of looking at, in the last 20 years, some of the economic upturns and downturns, we had the Ebola situation, and for everything that they saw, and they started looking at what's called CMBS loans, which are commercial mortgage-backed securities. Now, CMBS loans are probably the most primary loan that is used in buying commercial real estate, whether you're buying a very small building or a small strip center, or you're buying a huge, multi-million, $100 billion office building in downtown Los Angeles. You're typically going to get a CMBS loan. So they went back and they looked at all of their data. And this is not Fannie or Freddie. This is not bank loans. This is not the various loans and funds. This is just so far just only CMBS. And so what they're saying between now and over the next 2 years, the market can expect to see 13,000 loans, $148 billion in commercial mortgage-backed securities default. Over 13,000 loans potentially going in default. Now that represents 14% of the entire loan count that they have, and 11% of their dollar amount. So I mean, there's a huge amount of properties that are going to be coming onto the market. So let me just show you this real quick based on property type. You know, what you see here in the blue, these are the properties that are actually going to be liquidated, and they're going to be valued, they're predicting according to their analytics based on what the price was 6 weeks ago or 8 weeks ago. These loans that go in default, you could get some of these up to 65% discount of its value today within the next 2 years. And then the rest of the loans that didn't go in default on these CMBS loans, they're expecting a 19% adjustment in the pricing. That's just, that's CoStar's projections. You notice here retail got hit hard. Excuse me. They have a significant amount of defaults because a lot of them are small businesses and small, restaurants and shops and mom and pops and, and a lot of the strip centers. And so, retail right now is really, really tough. And then, of course, if you took all of these different categories, you see basically a 66% change in value on these loans that are going to default. That's what's going to liquidate, and the loans that are not going to liquidate, you're going to see some kind of an adjustment, price adjustment. There are REITs, real estate investment trusts, big investors and equity companies right now raising billions and billions of dollars to buy these properties here. And it's only, they're predicting in this article, a 24-month window. So, if you're interested in investing or buying property, you want to keep your eyes open, because I think, in my opinion, these things, a lot of them are going into forbearance now. They're trying to do a workout with a lender. I stay in touch with my mortgage brokers, but they're going to eventually start making their way into the market and coming back out. So just a little piece of advice, and this is just CMBS. So there'll be many, many, many other loans. Now, what are we doing to take care of those tenants that cannot make their rent payment? And I call this blend and extend. So this methodology is basically for me to preserve my values, preserve my occupancy, keep my property stabilized, and keep my revenues up. So basically, here's how it works. Let's say that we have a tenant that can't pay their monthly lease payment, and they're behind 3 months at $5,000 a month. So that's $15,000. So what am I going to do about it? What are we going to do? So the thing that we do is I have to make a decision whether I'm going to blend that $15,000 or I'm going to extend it out. So the first thing I'm going to do here is I'm going to review the length of the lease and determine the expiration date. So, I have a really big company. I don't want to tell you their name, that they couldn't pay their lease in my Charlotte property. And so when I went back and looked at their lease, they have 58 months left on their lease. So, so based on the number of months remaining, I'm going to blend the 3 months. I'm going to take that $15,000, and in the remaining months, I'm going to blend it into the first 12 months, or I'm going to extend it. So the way that I make that decision is that if I have a tenant that only has 12 months left or less on their lease, I'll ask them if they want me to blend it into the 12 months remaining, or I can add 3 months, and we signed an addendum, and now they have 15 months remaining. and I don't charge any late fees. Now, in the case where so I would extend their lease in that case. But in the situation where here, this big company had 58 months remaining, I took those 3 months of rent, and what I did, well, actually, once with the 58 months, I went ahead and I blended it in. I wouldn't extend it. The rent that's due today, I don't want to wait 5 years to get my rent. So if it's 12 months, I might extend it on the back end if it's 12 months or less. But if it's more than that, I'm going to take those 3 months at $15,000 and I'm going to blend it in. And starting next month, this is your new rent payment for the next 12 months. And so we'll get that 15 months started right away. So it's either blended or extended, and 12 months is kind of my cutoff. So what this does, obviously, it's worked very well. It keeps my cash flows up. It keeps my tenant in there. It keeps my values up because, when you buy commercial property, the most valuable thing that you have when you're selling it is the leases and the quality of those leases. So you have tenants in there. You've got good long-term leases and not, they're paying on those leases on time. That's how I am dealing with the COVID-19, and it's working really well. So this is my investment strategy. Then we'll leave it up for some questions. This is where I kind of think I'm at today, and where I think we're going on this is that I'm going to focus on the single-story office buildings like the ones in Charlotte that you saw. Those buildings are typically built in the 80s and 90s. The one thing about them, they have a vast, I get a vast amount of potential tenants because I have the belly of the entire tenant base out there. It's not that tall, administrative, white-collar office building. Because when real estate, if we have a real economic crisis here, it gets worse, and we start losing jobs. Remember, in 2008 and 9, it was those office jobs and that went dark first, and that's where the vacancy started. The only reason I bought that first office building in Dallas was because that was my very first one. And so I made a little bit of a mistake, but I got lucky because I'm in a market where they don't have any more office buildings, and the market occupancy is 98%. And I'm in the path of progress. They have a $1 billion project a mile away started. I can't tell you how lucky I got, but I would not buy that building again. I like those single-story office buildings because, it's like having a C-class apartment, which is my other strategy. Institutional grade, 100 units or more, B or C classes, because people that are lost their jobs, they started moving down, and all of my buildings are B's and C's. So in March, when things really started to get bad with the virus, my foot traffic in my apartments went sky high. Now, I didn't really have any foot traffic or anything I could do in my office buildings because all of that is one's 100% occupancy and the other one's 96. So, but again, if you're going to invest, it's a lot of this, a lot of the analysis is find a good location. So the last thing I like when it comes back is the service-oriented strip centers, and that's when the market comes back. I know a guy that made millions and millions of dollars during the real estate crisis in 2007, 8, and 9 and flourished. Unfortunately, what's happened today, this pandemic affects everything. Nobody's going untouched, but back then, it was different, and the circumstances were different. And so, instead of, going out and having a steak at Fleming's or the Capitol Grill or going to some really nice place, when people started, when the economic crisis hit, people still, had to go to work. They still had to get, the women still had their hair done. You still did your dry cleaning. Instead of going out to that really nice steak place, you went to maybe get some Mexican food or, some, just a Subway sandwich or pizza, or, people changed their habits. And so, the basic philosophy between this is that there was a grocery store anchor, which was the draw. These were nothing fancy, well located, And the grocery store, you have to go into the grocery store to buy groceries, and the rest of the tenants in the strip center, they were also service-oriented tenants. You wouldn't want to have a Best Buy or somewhere you could go in and shop it and then go back and buy it on Amazon or buy it on the internet somewhere. So these types of centers flourish, but right now these strip centers with these service-oriented tenants have unfortunately suffered dearly, but it's going to come back. So for right now, I'm going to stick with apartments and the single-story office. So this is the one that I would prefer not to buy going forward, in my opinion. People make a lot of money buying these, and we're doing great. But this is the type, again, that I really like, that single-story office type, because I catch many different industries. I have retail, wholesale, I have a technology company, I have a bank, I have doctors, I have just many different kinds. So I'm not worried if something happens in a particular industry, that this is the property type that never went below 92% occupancy during the entire real estate crisis. So thank you for your time. I went a little longer than I thought, Daniel, but if there's some questions.
We've got a couple of good questions. All right.
Okay.
First question from Abisha. What is the incentive for a tenant to pay for improvements versus finding another spot which is already improved?
Well, a lot of that has to do with the cost of rents, because everything is relative to the age of the building, and also the cost to move and the cost to have that improvement. Many times, I have a rule of thumb, whatever the rent is, say the rent's $15 a square foot, I will provide tenant improvements up to $15 a square foot, because after that you start losing money. So in the building type that you have, there's certain characteristics about it that your tenant liked, and that's why they're there. And so if they want to make those improvements, you can decide if you have that TI money set apart, whether it's worth it for you, depending upon how much that rent's going to be, how long that lease is going to be. You'd never want to do that if you were going to have like a 1 or 2 year lease. But it's really a judgment decision. There's no rule of thumb there, but a lot of times, they will do it and put up the money because they want to do it the way that they want it. As long as they don't hurt the building, I'll let them do that. But your question as well, it's a great question. And if they really want something and the cost to do it isn't there, and you don't have the money, then you may end up losing that tenant. You still there, Daniel?
Yep, sorry, I'm talking on mute.
Oh.
All right. Next question is from Jeff. How is property management for commercial office compared to residential?
Oh, geez. Well, I'll tell you what, I've owned some residential properties, and I got to tell you that the biggest difference between residential and commercial is the commercial side is much larger, and it seems to me to be really well organized, because you have really good companies and big companies out there like CB Richard Ellis and JLL and Cushman and Wakefield, and they have the managers, and they have all of the different brokers and expertise that know all these tenants in your particular property type. They have that intellectual property and those resources to support you and to service your office building. The fundamentals are still the same. Whether when you say residential, I assume you're talking about a single family home, Jeff. That's usually pretty straightforward. You have a manager, and then they have a maintenance person or somebody that goes by and fixes it, or they hire a landscaper. It depends on how many services you want. But one of the things that I like about on the commercial side, the depth of experience, and because especially when you get into leases and negotiations and if something goes on with the property, they have so many more resources in order to fix that problem it's just a whole different level and depth of experience. It's not, I'm not saying that it's better, it's just different.
What about from a cost perspective?
Well, the cost perspective is based on the revenue that you take in, just like any commercial property. Compared, if you're comparing it to residential, and what I've last heard, I haven't been in residential since 2002, but typically you pay that person 10% a fee based on the rent, whatever rent that they get. In commercial, it's dependent on the size of your apartment or your office building or whatever. It's usually around 3% or 4%. And so it's just all relative to the income.
Okay. Our next question is from Ad. How does one find out accurate cap rates for a particular area?
Well, the cap rates, in terms of its accuracy, it's really a little bit of a moving target because cap rates vary from asset class, from A, B, C, and D. And so the best way to find out is just ask, what were the most recent sales in the last 6 months for this property type in this area, because different areas have different property types. And so the only thing you can really go by is what was actually sold. I like I said, I follow the cash. Cap rates are important, but that's not. I don't use the cap rate to determine what my purchase price is. When I look at a property, after I get in and I figure out what all my costs are, how much money is left to pay my investor, and then after I pay my investor their preferred rate of return, how much money is left to pay us as the manager or founder of the deal. But cap rates change, and I would just use the last 6 months, Ad.
Hey, and Bob, actually, could you define cap rate for those who may not know what it is?
Yeah, a cap rate is a measure valuation, and the number determines based on what you're paying, how many years it's going to take. To pay the property off based on the debt. So, that's the simplest explanation.
Okay. Our next question. And Bob, do you have me on a speakerphone? I'm getting a lot of echo. I'm not sure if everyone's getting that. All right.
No, I don't. I'm just talking through my computer.
Okay.
I'm sorry.
Anitha is asking, is this the right time to buy commercial real estate, or wait for some more time to see the impact of COVID-19? And he has a follow-up question. Any guidance sources for new investors who want to enter the commercial real estate space?
Yes. Okay. So the first question, I have this note. Is it Anfa? I'm sorry, but I have this note on my desk, and I see it all the time, and it says, "Don't wait to buy real estate and wait." There's never really any good time or bad time, and I'm really contrarian myself. I establish what my financial metrics are, like how much cash, on cash return that I want every year. I look at, if I increase the rents over a period of time, what's my annualized rate of return? How can I create equity? And that's how I make my decision. Right now, today, if you're looking for particularly apartments, Fannie Mae, Freddie Mac, and a lot of the loans and the debt out there are requiring that you put in anywhere from 6 to 12 months of principal and interest payments up front. Along with insurance and property tax. As a matter of fact, I just lost a 338 unit apartment deal because a few days before closing, when the virus really hit, Fannie Mae changed the rules and said, you have to come to the table now even though I had my term sheet, we had agreed with 12 months of principal and interest, another 12 months of insurance. We want you to pay all 12 months of property taxes up front, and which is always paid in arrear, and 12 months of capital reserve. So that number came to just under 1.4 million in cash, and it made my deal not viable. And I already presented to my investors. They already wired in the money, but all of a sudden, I've got $1.4 million in debt and extra debt that I got, or equity I have to bring to the table. That it just made it difficult. So right now, if you're going to get a 5-agency loan, it's a really hard time to buy. I might wait for the virus and things to calm down if you're looking at an apartment. I haven't seen those same reserve with CMBS loans and some other loans, but it's always a good time to buy real estate, in my opinion. So the one word of advice I give you, and this is how what I did, is that if you're going to buy real estate, or even if you're going to give your money to somebody else and you have an interest in real estate, you want to be a really, really good underwriter, meaning you want to know how to analyze the deals and what those numbers mean. Be really good at your numbers.
Okay, we've got 3 more minutes left, and probably 3 more people whose questions I haven't gotten to. There's a couple of people with repeat questions, and I'm going to ask you guys to put those in the Yammer group, and we'll get answers for you. But from Dondi, and this is a big question, so we'll try and keep it as short as possible. I have a question related to commercial property. I would like to buy a piece of land that is available for sale in a shopping center area. The small square of land is perfect for a building or business, or a building that has a few businesses. Have you ever done such a thing? How different would this be? Would you ever use seller financing on such a project?
Well, I've never done that because I don't buy land and build on it, or I only buy cash flow properties and things that I'm sure of. I don't have a land development background, but I would, the thing I think you would have to consider, and this could be a great opportunity, especially if you have a seller willing to do owner financing, is that why would you do that? What is the best and highest use of that piece of land? Remember what I said at the very beginning, the 2 big things, what is it that you're going to do with the property, and how are you going to execute? Those are the things I think you need to find out. And if it makes good financial sense, and you have a willing buyer, and also you have to make sure that that particular parcel, that whatever it is that you think that might be its best and highest use, that it's zoned that way. So you don't have any problems with the city and the county getting your permits for whatever it is you'd like to build. But something definitely to explore, but I've never done that. I work pretty tight in what I'm looking for and the numbers I'm looking for in my business model.
All right, and our last question is from Harjot. What area is a great area for first-time buyers of commercial property?
Oh my goodness. What you want to look for are areas where you can see over the last 5 years of real economic progress, and you want to be in an area that's growing. Let me give you some examples of some cities that the projections on these cities are just terrific, and there's many of them, but I really like Charlotte, North Carolina, Dallas, Texas, Orlando, Florida. My goodness, Fortune had the top 3 places in the United States today to own investment real estate. And 1 was Orlando, 2 was Tampa, and number 7 was Miami. Because, when jobs are being created, people move to those jobs, and then from those jobs come, as you know, many other jobs. And so when the people come, the demand for whether it's housing or storage units or a strip center with all the services on it, to take care of the people moving in there, you want to go and see if there's what the track record is. Those are Phoenix is doing great. There's many places, but you just want to go in and make sure the area you're buying, that you're in that path of progress.
All right, Bob, we're hitting the top of the hour and people need to take off. So thank you very much for coming in and sharing at the Real Estate Education Club at Intel.
Yeah, well, thank you very much. I appreciate the opportunity and good luck, to all those that are on this call. And thank you for your time. I really appreciate it. And above everything, hey, stay safe.